that slowdown in goods trade has happened a little bit quicker than we expected. And so we brought forward some of this decline in productivity to be more within our forecast horizon. And that's one of the reasons why we do expect to see somewhat weaker growth in this supply potential over the next couple of years than we had previously thought.
Interest rates have gone up again, another 0.5% to 4%. That is the highest since 2008. So the big question is, what happens next? Will they go even higher? Our business correspondent Dominic O'Connell is here. Morning, Dom. Morning. The Bank of England was a bit more upbeat yesterday than it has been.
Yeah, it definitely was. It said it still expected a recession this year, but it wouldn't be as bad or last as long than it had forecast just a month ago. But rates did go up, the 10th meeting in a row where the Monetary Policy Committee, the body that sets interest rates, has put them up. Huw Pill is the Bank of England's chief economist and a member of that committee, and he joins us. Huw, good morning. Can you just explain the committee's thinking? Why did it put rates up?
So good morning, and thanks for having me on. I think at one level, the answer to your question is a pretty straightforward one. Our job is to get inflation to the 2% target that we've been assigned by the government. Inflation relative to that target remains much too high. Now, it's true that we have had some better news of late. Headline inflation has fallen from the peak we saw at the end of last year. And the wholesale gas prices, which have been the underlying driver of lots of the movements in the headline inflation measure we target, have fallen quite significantly over the last few months and weeks. But the MPC's job, and my job on the MPC, is not just to stop inflation rising, but it's really to return inflation to the 2% target and hold it there sustainably over the medium term. And I think the committee feels strongly that it needs to see the job through. And on the basis of the information analysis we saw presented to us over the last week ahead of our meeting, I think we came to the judgment that a further rate rise was needed. And, I am confident that that rate rise is one that was both necessary and appropriate in order to meet this goal of returning inflation to 2% and keeping it there over the medium term.
The market seemed to have interpreted what was said yesterday as it might be the final rate rise of this particular cycle. Do you think that's a fair interpretation?
Well, I don't want to get into steering interest rates, especially market interest rates, on a short-term, day-to-day basis. That's a bit of a mug's game. And my experience sitting on the committee over the last 18 months or so has demonstrated, I think, that you never know quite what's going to happen. So we have to be prepared for lots of shocks in potentially all directions. But I do think on the basis of the information that we've seen, on the information analysis we have with us today, I mean, as I just mentioned, and as you yourself mentioned, we have seen better news on inflation, and we have to incorporate that into our assessment. And I think what's more, we have to recognize that we have done a lot with monetary policy already. Interest rates have risen by almost 400 basis points over the last little more than a year. And given the lags in the transmission of monetary policy, there's quite a lot of the effects of those rises in interest rates still to come through. So if you like, there's a lot of policy in the pipeline. So as the governor noted and emphasized in the press conference he had yesterday after the decision, the committee has changed its language, I think quite substantially in what it said in explaining, justifying its decision and its assessment of the economic situation. And the economist and analysts that you're referring to picked up on that change on language. And I think that's something that is met with a certain degree of recognition and was intended. I think it's important that, as I've said, we do enough to attain our objective, return inflation to in target. But of course, it's also important that we guard against the possibility of doing too much. And the new language reflects that, flagging the need to keep that Zen-like balance in our objective. I mean, I think it's also important to recognize that the committee signaled a need for continued, if you like, watchfulness, and it especially emphasized that it was watchful for signs of further persistence in inflation, the type of inflation that might become embedded in price setting behavior, wage setting behavior, and threaten to keep inflation elevated above the 2% target on a more lasting basis. That's the type of concern that we've had. That's the type of concern that we still have. And I think, as ever, the committee is kind of willing and ready to act in order to do what it needs to do with that sense of watchfulness in order to get inflation to target and keep it there.
What about the coming year? The Bank of England still forecasts a recession.
Yeah. I mean, that's right. I mean, if we look ahead to the coming year, I mean, we think inflation will come down further, and obviously that's welcome. A large part of that fall in inflation comes from the fact that we will see the pass-through of lower wholesale gas prices into utility bills, and of course, that is welcome. That's a process that is going to take some time because of the various government actions in order to cap utility prices and so forth, but that will come through. And that will contribute to our expectation that by the middle of next year, we think inflation will be back at 2%. And that's obviously, at the heart of what we're doing.
So certainly at 4% by the end of the year, something like that.
Yeah, so I mean, because of the kind of mechanical effects of the very big increases in utility bills falling out of the annual calculation of inflation, which is the number we target, the number we're both referring to now. I mean, yes, we have a reasonably high degree of confidence that we will see inflation fall through the second half of this year. I mean, as I've tried to emphasize, the key question for us is whether beyond that mechanical fall, the sort of behavior going on in price setting, wage setting, cost dynamics in the UK economy, which of course has been influenced a lot by developments coming from the outside, higher energy prices, higher imported prices and so forth over the last few years, whether that self-sustaining dynamic in the UK pricing process is one that's consistent with our target. And that's really the sort of focus for the years beyond this decline that we anticipate for this year. But just coming back to your question around, if you like, the real economy, the level of economic activity, I mean, I think, the short answer to your question is the outlook we have for next year is a weak outlook. And that, of course, is less comfortable. We are forecasting a technical recession. So that means that we will see growth fall. I think, again, month to month and quarter to quarter movements in GDP, which are the sort of things used to define technical recessions. I mean, we may see, as we've seen, we expect to see in the fourth quarter of last year, a positive number. We may see a series of negative numbers. So I think the kind of notion of whether we're in a recession or not may be vary through the year. But I think the overall outlook for the coming year plus is a weak outlook. And that, reflects an improvement over what we anticipated in our previous forecasts. Interest rates are not as high now and are not expected to go as high, in part because inflation is lower, but in part because of the turmoil in markets in last autumn has passed through the system. And we will also benefit from the lower gas prices, implying a somewhat mitigated squeeze on household and business incomes, allowing them, greater flexibility to spend, and that will support demand. But I think it is key to see that underlying all this is still a very weak performance on the supply side of the UK economy. And that is what's keeping growth lower than probably all of us would like.
Well, that was one of the most interesting things about what the MPC had to say yesterday. The damage to the productive capacity of the economy, as you say, the supply side, how much we can actually make of stuff and produce of stuff. And the committee gave a list of reasons why it had been damaged: COVID, energy shocks, these kind of things, but also Brexit. How much of it is down to Brexit?
Well, I mean, I think we've tried to avoid, for good reason, sort of breaking down that weakness mechanically into the contributions coming from different things, in part because it's quite hard to separate those things, both in a practical, numbers sense, but also in a more explanation sense. When people have left the UK economy to go back home, if they were EU workers here in the UK, often that's a combination of effects related to COVID and effects related to Brexit, and separating those things is quite difficult. What we have said, and in fact we've said this for some time, is that on account of the disruption to trade one might anticipate on the back of Brexit, We do expect to see over a quite prolonged period following Britain's exit from the EU, we were expecting to see productivity, which historically has quite a close relationship with the intensity of trade. We did expect productivity over around a 15-year period to end up 3 to 3.5% lower, and that would have been a weighing on the productive potential of the UK economy. Now, what our analysis suggests is that some of that slowdown in trade, particularly in trade in goods, which seems to be something that is more associated with manufacturing, where a lot of that productivity comes from, that slowdown in goods trade has happened a little bit quicker than we expected. And so we brought forward some of this decline in productivity to be more within our forecast horizon. And that's one of the reasons why we do expect to see somewhat weaker growth in this supply potential over the next couple of years than we had previously thought.
Just one last point, again on Brexit, just to put it another way. We had the 3-year anniversary of Brexit this week, of course, and lots of people talking for and against it. In the people speaking for it, did you hear any evidence from them of how it had been a benefit to the UK economy?
Well, I think it remains too early to say. I think, as I said, the bank's analysis on trade developments, their implications for the productivity, that's the channel on which we have focused. We've also looked to some extent on the impact on migration and what the implications that has to labour force. Those types of channels, as modelled by the bank in the work we published on that, do suggest that has weighed on the supply potential of the economy. I think as yet we have not seen offsetting effects, at least in net terms, in the other direction.
Thank you very much, Huw Pill from the Bank of England.
Dom, thank you. Interesting. I was just going to mention to you, Dom, that in the report yesterday from the Bank of England, and the Times observes this, that the bank used the words uncertain and uncertainty 29 times in the latest monetary report. So despite the optimism, that seems to be the theme, as we were just hearing.
Yes, and I think, as Huw Pill said, he was keen not to say. He avoided the idea that, yes, we're definitely going to have a recession this year. He talked about how it might be variable quarter to quarter. And the technical definition of recession is 2 consecutive quarters of negative growth. So I think he's laying the ground for the fact that actually we might just have an up and down year this year. And the Bank of England was saying, not yesterday, but at its previous forecast in December, that actually, given even then the recession was going to be quite shallow, it wouldn't take much for Britain to avoid a recession completely. So I think there's an awful lot of uncertainty, and so much depends on energy prices. And if they stay at, they've gone down an awful lot. The forecast for the capped electricity and gas price now is below the cap itself. So if they stay low, then inflation falls off quite quickly, and everything falls out from that.
Really interesting. Thanks very much, Dom. Dominic O'Connell is our business correspondent.